Welcome to Money RX for CRNAs and nurse practitioners. If you are a CRNA or an NP and you've ever typed into Google or ChatGPT the question of how much money do I need to retire, or what is a safe withdrawal rate, or is the 4% retirement rule still valid? If so, then this episode today is for you, because I am going to start this episode by making a bold claim. The 4% rule is a bad retirement plan for most CRNAs and nurse practitioners. Not because it's the wrong math, but because it's the wrong tool for the job that you are trying to do. Most APRNs aren't trying to build a plan that says I will never earn another dollar again in my future, and I will only withdraw a fixed inflation-adjusted amount no matter what happens. That is not real life. Most APRNs want something a little different. You want work to become optional. You want to protect your family. You want to stop feeling trapped by income. And you want a plan that holds up in real life, like when the markets drop, or all of a sudden taxes surprise you, or your roof leaks, or you just decide that, you know what, you're taking that once-in-a-lifetime trip while you are still healthy enough to enjoy it. So today, we're going to do three things. Number one, I'm going to explain why the 4% rule gets misunderstood and misused, especially by high-income healthcare households. Two, I'll show you the real problem the 4% rule creates, like psychological stress, rigidity, and tax blindness. And then three, I'll teach you what to do instead. A work optional guardrails plan that combines a retirement paycheck timeline, which means cash flow planning, with guardrails, which means dynamic spending rules, and a tax smart withdrawal sequencing. And if you stay with me through the full episode, you will walk away with a system that you can actually use today. Okay, so let's talk about what the 4% rule actually is and what it isn't. Now let's first define this quickly and accurately. The classic 4% rule says this: you retire with a portfolio. In year one, you withdraw 4% of that starting portfolio value. Then each year after that, you increase the dollar amount by inflation. And so the goal is to make the money last for a historically tested time horizon, commonly modeled as around 30 years. And the entire idea came out of research that looked at different historical retirement start dates and then asked, well, if someone retired at the worst time and followed these rules, did they run out of money? And that's where the 4% rule came from. It is a stress test-based rule of thumb. Now, here's what it's not. It is not a personalized retirement income strategy. It is not tax aware. It is not behavior aware. It is not designed for early retirees. It is not designed for people with multiple income streams like Social Security, PRN, spousal income, rental income, etc. It is not designed for a household that can flex spending, like go back PRN or adjust their lifestyle if needed. And so that's why for APRNs using the 4% rule as the plan, it can definitely backfire. So next is, well then, why do high-income APRNs misapply the 4% rule? Well, in fairness to them, here's the trap. The 4% rule feels emotionally safe. I definitely think it reduces the stress of making decisions. I mean, you don't have to ask yourself hard questions like, well, could we spend more this year? Or should we cut back if the market drops? How much risk is okay for us? When should we take Social Security? And which account should we withdraw from first? Oh my goodness, what's our plan if inflation spikes? And what happens when required minimum distributions, RMDs, start? Instead, the rule hands you a single number, 4%, and says, just do this. Now, that is comforting, but comfort isn't the same thing as a good plan. So for CRNAs and NPs, especially those who are around age 45 to 60, and you're targeting a work optional timeline, then the 4% rule is usually misapplied, and I see 3 ways. First, people apply it to the wrong time horizon. Second, people treat retirement spending as a straight line when they're thinking about this. And third, people ignore taxes. And taxes are often the real withdrawal rate killer. And so if you've ever felt like, I'm not sure that I can retire, I'm scared I will run out of money. I mean, I don't want to underspend and miss my life, but I also don't want to overspend and be forced back into full-time work. Well, that's exactly what we're going to fix today. So to start, here are what I think are the core problems with the 4% rule. So first, the 4% rule is just too rigid, it's incomplete, and it's not how humans actually live. Now, to show you what I mean, let me break these issues into a simple set of real-life problems that hopefully you'll recognize and connect with. Problem A, it assumes a 30-year average retirement, and APRNs often aren't average retirees. Because if you retire at 65, well, then a 30-year horizon might fit. But if you retire at 55, now you may be looking at 35 to 45 years. So that 100% changes the math. But here's the twist. Many CRNAs and NPs don't do a hard stop retirement. They usually will first shift into PRN, reduced call, locums, maybe teaching or consulting, or maybe a seasonal schedule. So the question isn't, will my portfolio alone fund 30 years? The question is, how do I design income so I'm never forced to work? Now that's a very different objective. Problem B, it ignores the biggest practical reality. Your spending isn't linear. Your spending changes because life changes. You have different seasons. So some examples of this that you'll recognize. Your mortgage gets paid off. Your kids are off the payroll. You travel heavily early in retirement. You fund a wedding, maybe help with college again, or a grandchild's education. You cover health insurance before Medicare. What I'm trying to say is a single inflation-adjusted spending line is not real life. It is like a spreadsheet fantasy at best. Next issue, problem C. It doesn't tell you what to do when life surprises you. So let's say you take your 4% number and then your HVAC unit dies, or you have to help a parent, or your spouse all of a sudden needs a new car that you weren't expecting. Or like I mentioned earlier, you want to do something meaningful now while you're healthy. So you tap your account and you end up taking more than 4% in 1 year. Well, now what? Well, the 4% rule doesn't tell you what to do. It doesn't tell you whether to adjust. It doesn't tell you how to adjust. It doesn't tell you what a safe reset looks like or when to cut back. And so for most APRNs, that lack of feedback creates a lot of stress. On next, problem D, it ignores portfolio performance. So the rule says withdraw based on the starting value, adjust by inflation, and then just ignore how the portfolio is doing. Well, I believe that actually creates two huge risks. On one hand, you might underspend for decades if the markets do well, while on the other, you might overspend early in a bad sequence of returns. If either of those is the case, who is that logic helping? Which brings me to problem E. It ignores taxes and fees. Now, this is the one that hits APRNs the hardest, I think. I mean, two households can have the exact same portfolio size and then wildly different outcomes depending on their tax-deferred accounts versus their Roth accounts versus their brokerage account mix. Social Security taxation, IRMA Medicare surcharges, state taxes, and required minimum distributions, RMDs. Now, keep in mind, and this is huge, your spendable income is your after-tax income, while the 4% rule is a pre-tax concept in a world where taxes are a very real thing. So, knowing those problems, here's what we teach as the better goal. We use the term work optional, not never earn money again. So let me give you an APRN specific reframe for this. If you're a CRNA and at age 52 and you say, I want to retire, often what you really mean is, I want to stop full-time work. Maybe I want to protect my health. I want control of my future. I want to be able to say no. Well, that's not a quote-unquote traditional retirement. That is a work optional plan. And here's why this differentiation matters. The 4% rule was built on the assumption that you will never earn money again in the future. But for CRNAs and NPs, that assumption is usually just wrong. And ironically, that assumption is what forces the math to be overly conservative. So instead of designing a plan around I will never earn money again, we design it around a baseline spending level that's sustainable even if markets are rough. We have a flexible spending layer for good market years and a buffer plan like PRN or part-time work if markets get ugly early on. That is real life planning. And frankly, it's much more empowering than staring at a spreadsheet and just praying that the market behaves itself. So here is the work optional guardrails plan, our do this instead idea. And this is the core system I want you to use instead of the 4% rule. Step number 1. Build yourself a retirement paycheck timeline, like cash flow planning. So before you ever pick a withdrawal rate, you first map out your income sources over time. Think of them like seasons. And think of retirement as a timeline with changing cash flows. Ages 55 to 65. You don't have Medicare yet, so you're going to have higher health insurance costs. Ages 62 to 70. Well, there's your Social Security window. Age 73 to 75, depending on your birth year, RMDs will kick in. What is your mortgage payoff year? Are there any part-time or PRN income years? And are there any one-time goal years, like a travel surge or a remodel of your house, or you just gifting to family? Establishing this kind of timeline is more important than the withdrawal rate, because once you see the timeline, you will often discover that you don't need one withdrawal rate forever. You need different withdrawals for different seasons of your life. Step 2. Next, you decide your base lifestyle number. Again, this is after tax. So this is the amount of money that you want to be able to support you in normal years of life without stress. This is not your dream spending amount. This is not your travel every month amount. This is your baseline. And for APRNs, I like to define this as housing plus utilities plus food plus insurance plus healthcare, basic travel, and life enjoyment, and maybe a maintenance reserve. Again, all of those numbers are after-tax figures because you do not spend pre-tax dollars. We get this, but we don't remember that. So this is key. Now, step 3, use guardrails instead of one static percentage. And this, frankly, is really where the magic happens. So a guardrails strategy says that you start with a reasonable withdrawal amount. You set a lower guardrail. This is a portfolio value where you agree to cut spending. Then on the flip side, you set an upper guardrail. This is a portfolio value where you allow spending to increase. So this way, instead of asking what's the safe withdrawal rate forever, you can ask what spending level is safe as long as my portfolio stays within a certain range. And after 20 plus years in this business, that is how humans actually live. And it also solves the what do I do now problem because the plan tells you, plain and simple. Step 4, now you can add the clinician advantage. What I mean is your optional income levers. So CRNAs and NPs have a unique superpower. You can often create meaningful income with a smallish amount of work. So we can build a buffer menu, like 1 shift per week PRN for 12 months if the markets were to drop early. Or maybe seasonal locums or consulting role. This is not you going back to work. This is you using your skills strategically to protect your financial freedom if needed. And it dramatically reduces your sequence of returns risk, which is a huge risk you hear me talk about almost every week. Now, let's look at 2 case studies on this, because I want to make it real for you with an example. Let's meet Alicia. She's a CRNA, and her spouse, Jordan. Now, Alicia is 54. They want her to stop full-time work in 12 months. And their goal is work optional, not never earn money again. And here's their situation. In their portfolio, they have $2.4 million split across 401k, IRA, Roth, and brokerage accounts. On their mortgage, they have 4 years remaining. For Social Security, they plan to delay to 70 for higher lifetime benefit, and they want to travel heavily from ages 55 to 62, again, while they're healthy. Now, if they apply the 4% rule blindly, well, 4% of $2.4 million equals $96,000 in year 1. And then they have inflation adjustments each year after that. And if they choose that route, they will either feel boxed in and frustrated with this, or they will end up breaking the rules and then feeling anxious about what they did. So instead, we do the work optional guardrails plan. And here is their timeline view of spending. Ages 55 to 59, they have higher travel spending, plus they have to pay for their mortgage, plus they have pre-Medicare planning to think of. Ages 60 to 65, their travel moderates, but their mortgage ends. Then ages 65 plus, Medicare reduces a major uncertainty for them and frees up their paycheck. And age 70 plus, Social Security begins, so their portfolio withdrawals drop dramatically because they have this other income source. So now we get to apply their guardrails approach. So we're able to set a baseline spending level that they can maintain as long as the portfolio stays within the guardrails. We establish a rule that if the portfolio falls to the lower guardrail, that they're going to cut discretionary spending. And or Alicia does 1 PRN shift per week for a period of time. Now, if the portfolio hits the upper guardrail, well, they can take a raise and maybe travel more or can do gifts intentionally, whatever they want to do. This type of plan gives them much more permission to spend early if the conditions allow for it, because there's a clear plan if markets cooperate, and there's also a calm plan if markets don't. And most importantly, Alicia gets what she wants most: control, without living in fear of having a single percentage withdrawal rate. But next, let's address the elephant in the room. If you are a high-income APRN, your retirement success is often determined less by the market and more by your tax strategy. So 2 quick truths about taxes. Truth number 1, not all dollars are equal. I mean, $1 from a Roth is not the same as $1 from a pre-tax IRA. $1 from a brokerage account might be mostly basis, which is less taxable, or it might be all capital gains. Social Security taxation interacts with other incomes. And required minimum distributions, RMDs, can push you into higher brackets and trigger Medicare surcharges. Which leads me to truth 2. RMDs don't break your retirement, but they can ruin a tax plan if they are ignored. So we know that RMDs increase with your age. Now that in and of itself doesn't automatically mean that your plan fails, but it definitely does mean that you need account diversification, taxable, Roth, pre-tax accounts. You need withdrawal sequencing. And sometimes you need proactive Roth conversions in the gap years. So for many CRNAs or NPs, the most powerful tax window that we see is the years after you stop full-time work, but before Social Security and before required minimum distributions. Because that is when your taxable income can drop. And you can then convert strategically to Roth, or you can harvest capital gains intelligently, both of which smooth lifetime taxes and reduce future forced required distributions. So your takeaway should be this: a 4% withdrawal rate rule conversation that does not include taxes is 100% missing the point. Now let's look at another case study. Meet Marcus, NP. He's age 74. Now he is worried because his RMD percentage keeps rising, and he has always heard only and only withdraw 4%. But the IRS is forcing him to take more than that, more than 4%. So here's the key lesson. What matters is how much he spends, not how much he withdraws from one account. So in Marcus's case, he has $900,000 in a traditional IRA, $700,000 in a brokerage account, and $250,000 in Roth. Now, his RMD might be around 4% plus, and it's increasing with age. Well, let's say if the IRA forces $45,000 out in 1 year, but he only needs $30,000 to live. Well, then he can pay the tax and spend the $30,000 and reinvest the remaining amount in the taxable brokerage account, or maybe use it for planned giving, depending on his circumstances. So the retiree doesn't go broke because the IRS forced a distribution. They only go broke if spending becomes permanently unsustainable, their taxes are unmanaged, or markets plus withdrawals hit at the wrong time with no flexibility. So again, the solution is always a plan. It is not some average rule of thumb that was created 40 years ago. Now, let's address another common question. Well, what if I just buy something that's guaranteed to pay me more than 4%, like an annuity? So annuities can have a role for some households, especially for covering essential expenses by creating a floor of covered expenses. And they also help reduce anxiety about market volatility for many. Or they can provide longevity insurance. But here's the caution with annuities. So a payout that looks attractive on paper today may lose purchasing power over decades if it does not adjust for inflation. So the right way to evaluate an annuity is not how big is the payment. It is what's the inflation adjustment, if any? What's the total cost and trade-offs? What problem does it solve in my plan? What happens if inflation runs higher than expected? And does it reduce tax flexibility? So this is why I prefer our Guardrails plus tax planning approach as the foundation over an annuity. And then maybe selectively adding guarantees like an annuity if they actually solve a specific problem. Okay, to wrap this up, if you remember nothing else from this episode, remember this. The 4% rule is a starting reference, not a retirement strategy. For CRNAs and NPs, the better approach is 1, build a retirement paycheck timeline, your income sources and expenses that change over time. Again, think of them as seasons. And then 2, choose a baseline work optional spending number. And remember, that number has to be after tax. 3, use guardrails, upper and lower bounds instead of a rigid withdrawal rule. 4, layer in tax strategy and APRN income flexibility to reduce risk and increase your freedom in the future. Because your goal is not to follow a rule perfectly. It's just not going to happen. Your goal is to design a life where you can say, you know what? I'm working because I want to, not because I have to. Thanks for listening to this episode of Money RX for CRNAs and nurse practitioners. I'm Brett Fellows, and until next time, take care of yourself and take care of your money.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.